We've looked at the disposition of capital assets, and now we're going to turn our attention to the disposition of what are in essence non-capital assets, all of those other assets that are not capital. And what we're really looking at here are situations in which we need to understand what happens with the gain or loss, what's going to be recognized for tax purposes, how much gain is going to be recognized, how much loss, if any, is going to be recognized. And so we're going to start by talking about kind of a standard situation, and then we're going to look at all of the situations that are different, where it's not quite going to be recognized as we would generally think it would be. So what we're going to do is we're going to take this whole topic and break it down into what we call normal sales and then what we call non-recognition sales. So we'll start with the normal sales, and it's called normal sales because it's really what it is that we would expect it to be. In a normal sale, the gain or loss is the difference between the selling price and the adjusted basis of the property. And that selling price is what it is that we've received. So it's the fair market value of what is received. Cash, goods, services, whatever the case may be, the assumption of a liability by the purchaser. That's what we received. We subtract from that the adjusted basis of the asset at the time of the sale, and that is our gain or loss on the sale of the asset. Okay? It's what we receive minus what it is that we have given up. And that's straightforward enough. Couple of examples here. Stephen wants to sell his land he is holding for investment. Anne wants to buy it but can only give him her car as payment. Stephen paid $10,000 for his land and Anne's car is worth $12,000. Well, if they have an exchange, Stephen has a $2,000 gain on the sale of his land to Anne. He got $12,000 in the form of a car, but it's still $12,000 of value. Okay? Fairly straightforward situation. Second example, Vladimir has a machine with a $20,000 adjusted basis, and the machine also secures a $10,000 debt. Marina wants to buy the machine and offers Vladimir $15,000 cash, and she will completely assume the debt. Well, there's a couple of ways we can look at it. We can say that Vladimir received $25,000. He got $15,000 in cash, and he doesn't have a $10,000 debt that he used to. So he has a $5,000 gain. Now, since the liability is connected to that asset and they're both going to Marina, you can say, well, look at it, the asset has a value of $10,000 to Vladimir. $20,000 of asset, $10,000 of associated debt, and he got $15,000 for it. So either way, Vladimir received $5,000 more than he gave up. Okay? He received $5,000 more than he gave up, and that's going to be his gain. Now we have a small variation on a normal sale, and that's an installment sale. And what's happening in an installment sale is that the cash isn't paid all at once. It's going to be paid out over a period of time going forward. And so what we need to do is go through a little process here to calculate the amount of gain that's recognized in each of those periods. And we have a simple, it's not difficult, three-step process. The first thing we have to do is calculate the total gross profit. So the sales price minus the adjusted basis equals the gross profit. Okay? What we're selling it for, what we're giving up, that's going to be our gross profit. The gross profit is divided by the sales price to determine the gross profit percentage. What percentage of that sales price is profit to us? And then we're going to recognize gain each year as the cash is received. That gross profit percentage is going to be multiplied by the payment received during the year, and that gives us the gain to be recognized this year. Okay, the payments received during each year multiplied by that gross profit percentage is how much profit, how much gain is going to be recognized each year. We're not changing the total gain, we're just allocating that gain over the periods in which it is used or which it's received, which that payment is going to be received. Now, just a note here, the installment sales method is not available to dealers in property, which means it cannot be used for property held for sale in the ordinary course of business. So we're talking about not your primary business, but something to the side, a one-off thing, some unusual situation. Now, there's some exceptions to that, but those are outside the scope of the exam. This is not something that is available for a dealer. This is something that's used for those secondary transactions. We have an example here. Boris sold some undeveloped land to Alex for $1 million, payable $200,000 per year for 5 years. Boris had an adjusted basis in the land of $400,000. So normally Boris has a $600,000 gain in the year of the sale if he'd received all of that $1 million at that time. But it's the installment method. Not all of that gain is going to be recognized in the year of sale. The gross profit percentage is 60%, 600,000 divided by the million. And so every time Boris receives some cash, he's going to recognize 60% of it as taxable income. So every time he gets $200,000, he will have $120,000 as taxable income that year. Now, assuming that all of those payments are made, it's going to be $120,000 each year for the next 5 years is the way that taxable income is going to be allocated. Well, that's kind of the standard, straightforward situation. What we're going to turn our attention to now are what we're calling non-recognition transactions. And we've got 4 categories of transactions here in which no gain or loss is recognized on the current transaction. Usually what's going to happen is that the gain is going to be deferred and it's going to be recognized later when the new owner of the property disposes of that property. Okay, so the ones with the 4 situations, what we're looking at: gifts and inheritance, sales of a residence, the exchange of like-kind real business or investment real properties, and involuntary conversions. Okay, these are the 4 categories, and the big one is the exchange of like-kind real property. That's the one that we're going to spend the most time on, but we'll get there slowly and certainly. The first one we look at, gifts and inheritance. Generally, neither the donor, the party who's giving the gift, nor the deceased person in the case of an inheritance, the giver is going to recognize a gain or a loss on that transaction. So when you give the gift, when you're the deceased and you're giving in the inheritance, there's generally no gain or loss on that transaction. There are some situations outside the scope of the exam. So we've got this giving of the gift, giving of the inheritance. Generally, there's not going to be a gain or a loss on that transaction. The second situation is the sale of a residence. If a single taxpayer sells a home that they've occupied as their principal place of residence for at least 2 of the 5 years before the sale, they can exclude $250,000 of gain on the sale of residence from their income. Married taxpayers can exclude $500,000. Okay? Now, if you have to have lived there 2 of the previous 5 years, theoretically you're able to do this every 2 years. Okay? You're able to sell your home and not recognize the gain. Now, this makes sense, okay, if we think about it, because most of the time when somebody sells a home, they're going to buy another one. So if you bought a home for $100,000 20 years ago and it's now worth $300,000 and you sell it and you have a $200,000 gain, if you had to pay taxes on that $200,000 gain, you wouldn't be able to afford a $300,000 home to replace it with. You'd have lost $50,000, $60,000 in income taxes if you had to pay the tax on the gain from the sale of your home. So $250,000 for an individual, $500,000 for married filing jointly. That gain, you don't have to pay the taxes on it. Now here's the big category, the exchange of like-kind real property. Okay, if the properties in the exchange are like-kind real properties, and those properties are held either for productive use in a trade or business or for investment, no gain or loss will be recognized on the transaction by either party. The exchange of like-kind real properties used in a trade or business or held for investment, no gain generally is going to be recognized on that transaction by either party and no loss. Now, what's a like-kind real property? Well, essentially, real property and real property are like-kind. Okay, there's an exception for this if it's property outside the United States, but generally we're looking at if there's real property in the United States and real property in the United States, that's going to be considered like-kind real properties. And so the exchange of those real properties is going to fall under this. Now, I've said that generally no gain or loss is going to be recognized. There can be a gain recognized if boot is received. Okay, there can be a gain recognized if boot is received. And that's the big exception that we need to look at, the like-kind exchange that has boot in it. Well, we need to define boot. Boot is cash, other property, or the assumption of liabilities that belong to the other party. It's anything other than those like-kind properties that are being received, exchanged. Okay, if it's whatever the real properties are, anything else is going to be boot. And so if boot is received, okay, if boot is received as part of a like-kind exchange, some gain is going to be recognized by the recipient of the boot. Okay, some gain is going to be recognized by the recipient of the boot because the recipient of the boot is in a sense not exchanging all of their property. Some of that real property is being sold for that boot. And the gain connected to that part that's being sold for the boot, not exchanged for other real property, that gain we're going to have to recognize. But we start by looking at the realized gain. This is what we know and love. Fair market value received minus the basis given up is our gain realized. The question is, how much of that gain is going to be recognized? So the gain recognized is going to be equal to the lesser of the realized gain or the amount of boot received. Okay, we'll do this in examples. The amount of gain that's recognized is the lesser of the realized gain or the amount of boot received. And in this situation, losses are never recognized. Even when there's boot, losses are never recognized. Okay, the gain is recognized when we receive boot. So we have an exchange of assets. We'll get to the example here in a minute. We have an exchange of assets. One of the things we need to look at is, what is the basis of our new asset? What's the basis of our new asset? Very simple formula. If there's one thing that you need to know out of this video, it's this one. Okay, this is what's the basis of that new asset, that new real property that we've received. Formula, just need to know it. The basis of the old property exchanged, plus the basis of any boot given, plus the gain recognized, minus the fair value of any boot received, is the basis of the newly acquired property. Okay? The basis of boot received is fair market value. So we're looking here at what we gave up, the basis of what we gave up, the gain that's recognized, you subtract the fair market value of any boot that's received, and that's the basis in the new property. Okay? The basis in the boot is its fair market value. Okay, that's what our basis in the boot is our fair market value. So let's look at an example here to go through this with numbers. Roger had some investment land with an adjusted basis of $3,000 and a fair market value of $11,000, and some stock with an adjusted basis of $6,000 and a fair market value of $2,000. He exchanged these assets with Walter for some other investment land worth $12,000. Walter's basis in his land was $4,000. Roger gave Boot the stock that had a fair market value different from its basis. So let's look at this, what Walter has. Walter has a realized gain of $9,000. Okay? This is the fair market value of the land received, $11,000, and the fair market value of the stock received of $2,000. And his land had a basis of $4,000. So that's Walter's realized gain of $9,000. $13,000 received, $4,000 of basis given up. Okay? That's what we've got, a $9,000 realized gain. Now, Walter received Boot, so he can recognize gain. The question is how much? Well, it's the lesser of the gain realized or the Boot received. Okay? The realized gain was $9,000 and the Boot received was $2,000. So Walter's recognized gain is $2,000. Okay? Walter's recognized gain is $2,000. So how does Walter calculate his basis in the new land, that new investment land he has? Well, the formula. The basis of the old land exchanged, $4,000, plus the basis of any Boot given, none, plus any gain recognized, we just did it, $2,000, minus the fair market value of any Boot received, $2,000. So his basis in the newly acquired land is $4,000. Now, we go back, Walter had that land originally. Walter's basis in the land was $4,000. And now Walter's basis in the new land is also $4,000. Okay, so that's how that was calculated. Now let's look at another example. A building held by John for investment with a basis of $100,000 was exchanged for other investment real estate with a fair market value of $90,000 and a snowmobile with a fair market value of $20,000 and $15,000 in cash. So the snowmobile and the cash, that's boot. Okay, that's boot. Now, John's realized gain in this situation is $25,000. He received $90,000 of real estate, $20,000 of fair market value of snowmobile, and $15,000 in cash. So $125,000 of fair market value is received, and the basis given up was $100,000. So there is $100,000 of basis given up. Now, what we have in this situation is, again, the question of how much gain is going to be recognized. In the last example, we recognized the amount of boot received. But in this example, we can't, because remember, the amount of gain that is recognized is the lesser of the gain or the boot received. The lesser of the realized gain or the boot received. And so in this situation, the boot received is $35,000. The gain is only $25,000. So that's the amount of recognized gain, $25,000. Now, what's the basis in the new property? $90,000 using the formula. $100,000 basis of the old building plus no boot given plus $25,000 of gain recognized minus a fair market value of the boot received of $35,000. Again, that's the snowmobile and the cash. Gives a new basis of $90,000. So John's new property has a basis of $90,000, and that $90,000 is what's going to be used going forward for anything that has to happen with that. When he sells it again, whatever the case may be, that's his basis, the original basis in that newly acquired building. Now, this is that like-kind exchange. We're talking about real property. And so this is the bigger topic in that formula. What's the basis of the new property? Okay, if you know that, you know the topic. You know this is situation because it comes down to what is the amount of the gain recognized. Well, if boot is received, you can recognize some of the gain, either the realized gain or the fair value of the boot received, whichever is lower. Okay, and so we need to make certain that you have that because that's kind of the two questions or the three questions that can come out of that. What's the amount of gain recognized? What's the value of the new asset? Maybe even what's the realized gain on the transaction. So if you know that formula, you know what you need to know for this topic. Now our last situation is what are called involuntary conversions. And this is descriptive. It's a conversion, it's a disposal of the properties converted into something else, not at the choice of the owner. The taxpayer didn't make this choice. We're talking about fire and theft loss. Property that's condemned or seized by the government for some reason. Okay, an involuntary conversion. The general rule is that the property if the property that is involuntarily converted. Okay, we have this property, it's involuntarily converted. If we replace it with property of similar or related use, by the end of the second tax year after the tax year in which the gain is first realized, the taxpayer can elect not to recognize the gain on the disposal of the property. Now, this makes sense. You have a car, a tree falls on your car, you have a building, whatever it is, you didn't choose to convert it. It's very possible through insurance that you have a gain on that transaction, or that event, not really transaction. You have a gain on that event. Well, generally we're not going to have to pay taxes if we replace it with similar or related use property. Okay? Now, the gain might be recognized if all of the proceeds that we received from the insurance company, if we were able to sell it for some amount of money, if we don't use all of that money that we received to buy qualified replacement property. So if we get the money and we don't replace the asset that was destroyed, well, then there's going to be a gain because we don't have a car anymore. We don't have whatever it was. We've replaced it. So the missing replacement period, if we miss that replacement period, or we don't replace the property with similar related use property, that makes this involuntary conversion taxable. Okay? That makes this a taxable conversion. Now, similar or related use. Well, it's not exactly the same. It needs to perform the same services, be functionally the same. So if you had a blue car and you replace it with a red car, that's okay. It's a car. Okay? It's a vehicle. Okay? It needs to be able to perform the same services that you were getting out of the original asset before the involuntary conversion. So what's the basis of the replacement property? Okay, we have new property. It's the cost of that new replacement property minus any gain that wasn't recognized on the disposal of the previous property. Okay? So really what's happening is the gain is just being deferred to future periods. Okay, we're reducing the basis of that replacement property by the amount of the gain that we didn't pay taxes on. So when we go forward, if we sell it in the future, there's going to be not only the gain from the appreciation of the replacement property, but also the gain that wasn't recognized on the original property that was destroyed. Okay, and so we always have, it's just being pushed. We're going to have to pay it. It's just being deferred until something else happens a little later down the line. Now, we do have some special rules connected to this. Okay, these are disaster relief. They're called special disaster relief, and these relate to natural disasters in the U.S. Okay, so we're not talking about a tree falls over on your car. We're talking about a hurricane. It's not just you, but it's a whole lot of people that were impacted by it. So these are the special rules. We can exclude from taxable gain any insurance proceeds received for unscheduled personal property. We can elect for insurance proceeds for a home and or its contents to be treated as one item. Okay, so instead of having 80 different items, it's just one item. And if we make a timely reinvestment in another home or contents, we can elect not to recognize the gain. And we have a 4-year period to replace the assets. Okay, we have a longer time period to replace the assets when we have a natural disaster, and we have a special disaster relief. Now there is a current, and it's going to be current for a while, modification to all of this. Current tax code modified this for tax years 2018 through 2025, okay, connected to the itemized deduction for personal casualty and theft losses. And under this provision, what's happening is an individual can claim an itemized deduction for personal casualty loss only if such a loss was attributable to a disaster declared by the president. Okay, so it has to be declared by the president to be a natural disaster. An exception applies to the extent a loss of an individual does not exceed the individual's personal casualty gains. Okay, so you can't make it a loss out of it, but you can offset your gains. Just kind of a minor detail that we need to mention for completeness. Now, let's look at this with an example and see how this all works together in terms of what the recognized gain is and what that basis in the new property is going to be. Dima had some land with a basis of $30,000. This land was condemned, seized by the state. The state paid him $35,000 for the land, which gives him a $5,000 gain on the event. Dima reinvested $32,000 in similar use property. So our question is, what is Dima's recognized gain, if any? And what is the basis for Dima's replacement property? Well, he's got a gain. And there's going to be a gain for tax purposes. There's going to be a recognized gain because Dima did not use all of the money that he received in the replacement property. He received $35,000. He used $32,000 of it for replacement property. So $3,000 of the gain is going to be taxable because it wasn't used to put into the replacement property. The new basis in the land is going to be $30,000. The $32,000 he paid for it minus the $2,000 gain that was not taxed. That $2,000 gain, he sold it essentially for $35,000 and it had a basis of $30,000. So he had a realized gain of $5,000. $3,000 of that is taxable now. $2,000 of it will be taxable when he sells the land. If he sells this replacement land right now, theoretically it would be worth $32,000. He just bought it for $32,000. Well, he has a basis of $30,000. So if he sells it right away the next day for $32,000, he's going to have a $2,000 gain on the sale of that replacement property, which, when added to the $3,000 gain that was recognized initially, that's the $5,000 gain. So it's not that the gain is lost. It's just deferred. It's going to be recognized when that replacement property is sold, if that replacement property is sold. So we've gone through the non-recognition transactions. They're not individually terrible. There's nothing difficult. Gifts and inheritance, sale of residence, pretty straightforward. Involuntary conversions, pretty straightforward. The exchange of like-kind real property, well, there's a little bit there, but if you have that formula, to calculate the basis of the new property for the person, that formula and that issue of recognizing some of the gain when boot is received, you have that formula and the way to recognize the gain, you're fine for any questions about that exchange of like-kind real properties. So don't get worried about this. You need to make certain you know it. These are things that are going to be tested, something out of here. But don't panic. Don't lose sleep over. Just make certain you understand gifts and inheritance, sale of residence, the involuntary conversions, that formula, and how it is that we recognize gain on the exchange of like-kind real property.